Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And looky Lou, it's Mr. Michael Becker. Michael, how are you?
Paul, doing pretty good today. Just trying to keep up with this crazy market that we're living in, but I think things are going good.
You know, talking about the crazy market, a friend of ours sent us a sign of jobs in the San Jose, California market. And this is for a restaurant. And there's a bunch of flyers in the window that talks about an opportunity to go work for this restaurant. And the lowest common denominator job is a dishwasher. And it was $21.50. The bussers were $23. The cashiers were $23. The prep cooks were $24.50. And the line cooks were $25.50. So there's no doubt that there's a $30 McDonald's Big Mac coming in the future there, Michael. Can you believe the amount of inflation for wages?
The fight for 15, I guess they won that fight over in San Jose, at least, huh?
It's not 15. It's guys that are making $25.50 an hour flipping hamburgers at a major restaurant in San Jose, California. But you know, that just talks a little bit about the wage inflation that is in Northern California that I don't know if it's coming this way. So maybe we'll talk a little bit about that with our guest and get his prognostication about where he sees, you know, the movement of employees from one state to the next and kind of figuring out where this market's, and it's a crazy market, where it's going to. So on the podcast today, we have a friend of ours that we've known for a long period of time, and we think he's one of the best in the business. He works for one of the largest brokerage companies in the United States. And I'm going to have Mr. Michael Becker introduce our friend, Jakob Andersen.
Yeah, so Jakob Andersen's with Newmark here in Dallas. Jakob, how are you doing?
Very good. Thank you for so much for having me, guys.
Yeah, it's been we had Jakob on, I think 2 or 3 times before already. It's been probably at least a year and a half or so since we had him on. So it's been, you know, quite a lot of changes over the last 18 months, in particular, really kind of the last 9 months or so of 2021 that we've been in. Has been quite the rocket ship that we've been living on. So maybe, Jakob, before we get too deep into kind of the state of the market, which is basically what we want to talk mainly about today, maybe give everyone just kind of a brief background on yourself, Newmark, and maybe for the reference, kind of what kind of sales volume does your shop here in Dallas do?
Yeah, absolutely, Michael. So I'm a part of Newmark, which is a national company and actually international company. We have affiliations in London, Australia, and Asia as well. When you go into the national market and more particularly in Texas, we have an office here in Dallas-Fort Worth, which I'm working out of. And then we have partners in Houston and in Austin as well. So we cover the full state of Texas. Our office this year will produce for about $2.5 billion of inventory. That will be a record for us. Typically, over the years, we have been circling around 1.5 to 2 billion every year. We strictly focus on multifamily out of our office. Some of our affiliates here, they are also doing office, whatnot. But our 100% focus here is multifamily, and that goes from basically a fourplex up to the biggest deals. There's around 100, 200 million.
Yeah, and that's a lot of volume. And, you know, Jakob and his team at Newmark are, you know, one of the guys you need to know if you want to be a player in Dallas-Fort Worth. They have a pretty large market share within Dallas-Fort Worth, you know, certainly one of the top, 4 or 5 broker shops in town. So if you guys don't know Jakob and you want to be a player in Dallas-Fort Worth, he certainly is on the list of people to call. So speaking of that, Jakob, maybe we kind of just set the stage real quick. Since the last time we talked, obviously we had the COVID lockdown, shutdown, economy's kind of reopened, and then the market's been kind of on fire. But maybe you kind of talk the last, say, 12 months or so, what's kind of really changed from a market standpoint in the last 12 months from like a pricing and kind of general sentiment standpoint? What have you observed?
Absolutely. And Michael, to kind of get you on what you started and said, did something happen over the last 18, 24 months? We can still say that properties are made out of brick and mortar and roofs, and the rest has really, really changed dramatically. When we look back and we're seeing and talking about these matters, saying, hey, are we on the top of the market here? What's going to happen today? Do I overpay for assets? Then COVID hit. Everyone got a bit nervous. How is tomorrow going to look? And I will say in 2020, especially in the beginning, everything kind of came to a stop. We could not perform due diligence in deals. We just couldn't execute deals. So sitting over last summer and going into Q3, Q4 of 2020, there were a lot of money sitting and that were not been put to work yet. So right off the gate, we picked up the deals that were put on hold, and most of these they already sold. And what happened too is on the renter side, everyone had been fairly conservative with rent bumps on existing tenants, didn't want to have too much exposure to the market. So when we walked into Q1 and Q2 of 2021, suddenly deals started to get huge trade outs on deals. And we're talking here starting at 8-10% going up to 20-25% with new leases over old leases. So having said that, and having that a dynamic in place for the fundamentals of the apartments here, and also having a lot of money that have been sitting from 2020, great appetite for the apartment market, that has created quite the market here the first 3 quarters of 2021.
So you're seeing, tremendous rental rate growth and, historically low interest rates. And then so that, and you seemingly have about 2 years worth of capital trying to be placed into 1 year, or at least, maybe an extra 6 months worth of capital that didn't get placed last year, trying to come into this year as a carryover plus our allocation for 21. What are you seeing to kind of generic cap rates across the metropolitan area today, say relative to a year ago? Do you have any? Obviously they're down, but what kind of dramatic compression of cap rates are you kind of noticing right now?
We are seeing some compression, and when we're in the fives, there are a lot of people say we cannot go on the fives. We went into the fours, and people said that now that's the end of it. In today's market, we are seeing deals in the Metroplex here and in Texas trading in the threes. Depending on the opportunity, if you start with the Class A buildings, there's less renovations on those. It's more of the in-place cash flow. You just underwrite straight up. You're probably looking at a 325 to a 350 cap rate going in. The interesting thing is when you see some of the value add deals trading, and this is mainly B assets built in the 1980s, some in the 1990s, where you can go in and modify interiors and exteriors. We are seeing similar cap rates on well-maintained deals. You're still in the threes. And when you go into more the C and the Bs, where they might need some repairs, you're looking at, it could be from a high 3 to a mid 4. So in comparison to if we take pre-COVID, we were probably around 100 basis points across the board higher in the Metroplex.
So we've seen from last 18 months about 100 basis point compression from beginning of 2020 to today.
Correct.
So who's buying all this stuff, right? I mean, I know we said the buyer pool is deep and diverse. Is it kind of, how's that changed or morphed over the last really this year? What's kind of different? And what's the same as far as kind of the buyer pool by the different property grades?
That's a really, really good question, Michael. What we have seen is typically in this real estate market, and particularly in multifamily, we were able to categorize who is buying what. And if I would have a C deal, I knew these would be the players. B deals, slightly different. Class A assets, it would be a certain group, groups of funds, REITs, institutional buyers that would go after that. The world has turned over quite a bit. Now we are seeing the people that bought the CB assets going for the Class A, the ability to raise money on a website and web hosted meetings has grown tremendously. So you're seeing that part flattening out quite a bit. So suddenly, if you felt confident raising $5 million, the same guys can now raise $20 and $30 million. The other way around, we have, and this is across the United States, a supply issue with affordable living. That is some of the things that some of the bigger players that's traded on Wall Street are picking up on, and they allocate funds to some of these affordable assets. So you will also see names, household names you typically would that would go after a Class A property now go down and invest in Class B assets. So it's more of a mix across the board these days.
So that doesn't really make a lot of sense to me how these institutions go down. Is that you hear a lot of headlines if you watch financial news like CNBC or something like that with the ESG movement, environmental, social governance? Is that largely due to some sort of non-monetary cause that maybe has some hot money that wants to get allocated to the ESG, and the ESG version of multifamily is 1970s deals in South Irving? Is that kind of what you're seeing?
Some of it is, yes. And I will say when we have some of these bigger institutions, they will not go after 100 units in South Irving. It needs to have a certain volume deal-wise. So we are seeing some of these that have been packaged as portfolios go into these bigger players. Their problem is to execute. They need a certain dollar volume to make sense out of it, but they will absolutely go after some of these, I would say, more blue-collar locations over just a main location. And this is all to service the money they're raising, they're coming into their funds.
Let's talk a little bit about, money raising these days. I mean, a lot of people listen to the Old Capital podcast are syndicators, and they started off, whether they started off today or they started off 3 years ago, about buying the Class C properties with the value added component to it. And it was easy for them to raise money when they were offering to their investors 13, 14, 15%, say cash on cash returns. Now, what are you seeing when you have a tour that goes out and you have a syndicator that wants to buy one of these Class A minus B plus properties? Where are they getting their money from, and what is the syndicator investor expecting for rates of return on their money these days?
Yeah, that's actually a really good question, Paul, because the market has moved, and we can talk about a Class C or Class A asset here. The returns are not the same as we saw, let's say, 3-4 years ago. A lot of these deals has been optimized at this point. The value add is thinner in general, and the returns are thereafter. You can't blindly go in and promise your investors to get out of a deal, let's say in 18 to 24 months, and just double your money to put a little bit of paint on the property. So what we are seeing is the people that are effectively raising money, they have their story down. They know what's going on in the market, and they are good at being transfer that information to the investors. So they set the deal right and set the expectations correctly up front. Some of these 13 and 14% returns, now we're looking more of a single-digit returns, and that can be an 8 or a 10 these days that the market can hold. Now, again, what we're looking at is the alternative in the market, and with the all-time low interest rates that are continuing to carry on, it's tough to just find a secure place to put your money and replicate still the same story as we see in multifamily and in commercial real estate in general.
Can we give some of these syndicators in the B and C space some hope about coming up into the A minus, B plus space? Is there more competition the higher quality you go? Is it lower competition? Tell me who's buying this A minus or A properties.
Yeah, I would say the way the world works and information flows these days, a lot of people, even though it might be 50 or 100 units in Irving, people will know about it. So the way of communicating and saying, hey, no one knew about it, that's in the past. So what we are seeing is that the competition on such a deal will be as high as some of the bigger ones. The one thing I would say when you're raising money, and you might just switch asset classes, and then you might be a little scared who you're up against. The one thing I would say that really behooves smaller groups is the decision making, because a lot of the bigger groups that are going after these assets, they will have boards, they will have to report to, they will have investment committees. They cannot change an LOI on the spot just to react to a seller's comment. So that's one of the things that we're seeing. Smaller groups that may not have the resume as some of the bigger ones really succeed.
Michael, you've done a great job with your group to buy these A-class properties. Again, you didn't start out buying the A-class properties, but you've transitioned into buying the A-class properties. And then you also, I think you found, and correct me if I'm wrong, maybe a little bit less competition on the higher the quality is, but a lot of the brokers like to deal with you because you are the decision maker. Just like Jakob said, you don't have to bring it back to an investment committee and then vote upon it and kind of tweak it, and not being, having a decision come back after 30 days that you're no longer interested in the deal, even though you may have a big name on the door with another company, an institutional buyer. SPI, as an example, is a smaller company, but you guys will put hard money in. Is that good advice for maybe some of the people that are up and coming?
Yeah, it's just different buyer pool. I mean, as Jakob mentioned, you mentioned, there's a lot of household names, some institutions but they aren't as nimble and not as entrepreneurial as some of these other groups like ours can be, where, it's our money and we're going to put up the earnest money. If we can't raise it, we're going to lose our own money. I don't need to go through some sort of investment committee and check 1,000 different boxes before I say yes. We got to be a little more nimble. So that is certainly the advantage that you have, kind of being the David against the Goliath out there now. I've noticed the last, say, 6 months in particular has become even more and more intense on the pricing escalation. So, where we were doing really good, winning a lot of our unfair share of deals up until about, maybe April or May. And all of a sudden it seems like April or May, the light switch is flipped. And I don't know if, Jakob, you have any sort of comment, but like seemingly to me about April or May, it's like these institutions said, I need to allocate money to Texas multifamily, and I don't care what the price can go where the price goes. I'm going to pay the most. And that's what it seems like has happened. I don't know if you have any sort of comments around that, or if you observe the same thing. And if there's any feedback to why the hell that is, and your opinion of that.
Yes, absolutely. And there is a little bit of an insight to that. And we do have a case study on one of our recently transacted properties. Some of these bigger groups, they typically have been buying heavily on the East Coast and the West Coast. They've been pressed from all angles there. And the prices, believe it or not, we think things are expensive here now. It's nothing in comparison to when you actually go to an LA or New York per unit pricing. Now, both have put rent ceilings in, whatnot. All that has really helped putting Texas on the map. It is no secret that Texas has been very outbound with their political messages of how friendly we are here to businesses. That is one of the things that are really starting to take effect. And what that translates into, that is something like Wall Street is also listening to. And you have some of these funds that are traded, or REITs that are traded on a stock exchange. Now, when you go in and you evaluate a certain stock or a portfolio, you're looking at locations and whatnot, and you get pluses and minuses. One of the things that has happened on the New York Stock Exchange is that they have been dinged up if they don't hold assets in the Sun Belt, and more specifically in Texas. So we are starting to see some of these bigger companies coming down, and this has maybe little to do with the actual asset, but as much to do with their presence in the general market. They have to buy something. They have to put a flag in Texas, and it's typically Houston or it's Austin or Dallas, that they want to have a presence in. So we have seen that. It has been less about suddenly what is the exact cap rate. We're saying we like this asset. It's something that will work for us for the foreseeable future, and we're buying it.
And that's been just escalating the price, right? Because it just seems like they're disregard of the fundamentals in certain cases. It just has to be there, kind of like the Federal Reserve when they're buying U.S. Treasury bonds. They just got to buy regardless of price. So whatever the price is, they're going to pay it. That's what it seems like the mentality, and it seems like that happened kind of mid-spring this year to me. Does that kind of jive with your recollection?
You're correct. You are correct. And the interesting thing is we like to set fundamentals up for us, and I still stick to a lot of those fundamentals. But sometimes another set of fundamentals comes in and plays in. And when that happens, it's switching everything. And in this instance here, with the good market we still have, and I think what COVID has showed us is we are still very sound here when it comes to it financially in Texas. We've seen a lot of people coming in. We are projected now to potentially create 200,000 jobs here the next year. So all those things put together, it shifts away from the importance of if it's 8% payback or a 10% payback. That becomes more irrelevant in that situation than yesterday. And if it's a 3.5 cap or a 3.0 cap, that will even out.
So with all this money coming in, with fundamentals being really strong, cap rates compressed, but for good reason, it seems like that's cheap. Rental rate growth going crazy. There's a large interest in both large employers and capital both coming to our market here in Dallas-Fort Worth. If there is any value that you see out in the marketplace, like relative to everything else, where would Jakob Andersen be putting his money? Urban, suburban, Class A, Class C, something in between? Is there any sort of slightly undervalued segment in your estimation right now?
That's a tough one. I think it really comes down to a lot of the sponsors. And when we get people in, especially that's not from here, that doesn't drive the submarkets every week to know exactly what's going on. I think it's really as much about the match for the specific group. I can point to deals I think that are really, really good in maybe a tougher location. But if you have the skill set to drive that asset, it can be an extremely lucrative deal for you. When we look at the overall and kind of just the overall picture, and we take workforce housing as an example, we're seeing markets like a Garland or Mesquite that has been slightly forgotten for many, many years. Now, on that side that sits east of Dallas downtown, it doesn't sit in the middle of the Metroplex, but we're starting to see so much growth, new development on the other side of those locations. So now suddenly it's starting to move more into the middle. That's a market where we're seeing consistently very high occupancy numbers, and we have also seen very solid rent growth. When it comes to the new construction, it has really been a question of supply and demand. And there are certain areas in Dallas that have created a ton of jobs. And here I'm talking about Planos, the Friscos, the Richardsons of the world, close to Tollway, close to 75, the major corridors. What we've seen over the last 4 or 5 years is that a lot of developers have gone into the same intersections, and you might have built or been under construction on 3, 4, 5 deals at the same time. Now, short term, the supply demand for that specific location is off. There are just too many units that are leasing. They're cannibalizing from each other. The one thing we saw during COVID here, it has put a little bit of a brake on new development. So the supply or the demand has caught up with the supply. And a lot of these newly constructed deals, they have leased up, and now they're in the mid 90s. So that has put pressure back on the market. So when you go in and look at certain locations, and for example, with new construction or newer deals, Class A deals, you always need to look at the pipeline and what is around you and how many construction starts are coming around. It is less these days here in 2021 than in 2019. But that is one of the things to kind of look out for in a market when you go after it.
That's a good point, because I've seen these deals that normally in lease up velocity would take 12 months to lease up. Maybe they're doing 20 leases a month, and all of a sudden these deals are leasing up in 6 months, and they're doing like 20 leases a week, and they're getting the concessions off. And then all of a sudden it seems like these developers are able to list these properties at 40% occupancy on, 50% lease, 40% occupancy on the way to stabilization, and they're getting kind of stabilized pricing. Seems like the market is willing to pay stabilized pricing for unstable product, which is just staggering to me. But that seems to be the last 4 or 5 months of Texas multifamily right here.
You're absolutely correct. That is one of the things. And it's again, I think everyone is trying to find a way on having an edge. One thing is time. And when you have an asset that is not picture perfect yet, but you can see the trend, there have been an increased number of groups that are willing to take that chance and can see where it's going and pay you for the product or what the product should be in 3 or 6 months.
All right, let's have the two prognosticators, the guessers, the wizards of Main Street of apartments. We've already seen $300,000 a door of new construction Class A in the Dallas-Fort Worth marketplace. Jacob, Michael, when is it going to $400,000 a door? Now, is Dallas next to an ocean, or is it next to a marina? Or why would he even be thinking $300,000 or $400,000 a door? What's going on, and when's that going to happen?
Yeah, that's it is when you have been in the market for a while, and that's a new number. I think it's staggering to all of us to see that. But then when you take a step back and do a little bit more research and seeing what's going on around you, and here I'm just picking a couple of other markets. We go right down 35, about 3.5 hours to Austin. That's a smaller market. I would say it has been reacting a little quicker than DFW for some of these influx of people, whatnot. In Austin, you have hit 400,000 a door. You go to the states out still in the Sun Belt, Arizona, for example. Phoenix is a very good market where we've seen a lot of rent growth. I've heard stories of people going in completely overpaying for a property, 400 plus thousand a door, and they just refied it and recapped the deal at 500,000. So I think what's important here is to maintain the same, or maintain some reference points in the market live. And when we look at it, that's where we're going.
Yeah, Paul, I don't know. This pace, this time next year, we might be there. I don't know. You think at some point it'd moderate, but I mean, if we genuinely see 15% rental rate growth, especially on the kind of the Class A's and kind of that mid to high teens right now, rental rate growth, it won't take long for us to continue to see pricing escalations. So when does rental rate growth moderate, I guess, is really kind of the biggest question. So the way we do our renewals around here, we're 2 months, maybe a little bit more out. We're sending renewal notices out, and so we are kind of mid September as we record this, and I'm looking out and I'm seeing all the way to November in the future, and I don't see any moderation on renewals and both percentages and renewal rates. So that tells me pretty much the rest of 2021 we're going to see abnormally seasonally high renewal rates. As well as retention rates being, much materially higher than kind of, usually as you go into the winter, the kind of colder fall, winter months, they tend to moderate, and it's not going to moderate this year. So if we blow through the slow season with higher rental rates and renewal rates, and then we kind of get back into the seasonally higher demand of the spring into the early summer, I could make a good case that we're sitting here in the next 12 months, we're going to see double-digit rental rate growth. And if that's the case, we might be to that number before you know it, because it's just a function of math. Because I know our expenses are going up, as you started the podcast off with $21 to wash a dish in San Jose. So that's translating to maintenance and leasing personnel on site. But the revenue at 15% is going to certainly outpace any sort of operating expense increases to a wide margin. And if we're seeing 15% rent growth, it's kind of like buying Tesla stock versus a utility, there's going to just continue to drive the cap rates down and pricing up. Where we're seeing that kind of growth, and more capital is going to come here. So, I don't see what stops it kind of the next year to two. I think we have a hell of a good run ahead of us, Paul.
Jacob, talking about what Michael said, do you see any storm clouds on the horizon? Is there anything that Newmark has brought to anybody's attention that there's any warning bells out there that the group is seeing?
Not currently. We just actually got hit here with a hurricane on the Texas coast. That's probably some of the stuff to just generally look out for. We had one that was bad for Houston a couple of years ago that created some issues. But the fundamentals, again, continuing back to see what are the holes, what are the threats for the future. It's hard to see right now, Paul. So I've learned my lesson going back to where we started and talking about 18 to 24 months ago. The picture is about the same for our projections of continuing to add jobs here, and wages have not now gone up. And I think that has benefited the affordable segment of this multifamily business. So it's really, really hard to find specifics out there that would derail this.
Major tax reform, that might be something out of left field. Major tax reform, that'd probably be the biggest likely thing. That get rid of the 1031 or something like that, which I don't think is probable, but that might. God knows what that would do.
Absolutely.
I'm trying to forget that one.
Yeah, we don't want that to go away at all. But if now you sell Class A, B, C properties, if somebody wanted to build a relationship with Jakob Andersen at Newmark, what's the best way for them to get a hold of you?
What I would do is I would email me just a quick intro, so I have your contact information and a little bit about what you're actually looking for. I can be reached on my email, which is jakob.andersen, Andersen, at nmrk.com. Send me a quick note and give me some feedback on what you're currently looking for. I'll do my best of matching it up. Let's have a conversation over the phone. And if you're in town, or if you're planning to come to town, even better, so we can go look at some live product.
Sounds great. Some great information, Mr. Positive, Mr. Jakob Andersen from Newmark. We certainly do appreciate you coming on and spending some time with us. And Michael Becker, any final words before we say goodbye?
That's it. I got to hop to the next thing, but market. So appreciate Jacob coming on, and look forward to hopefully getting another deal done here soon, bud.
Absolutely. Thank you for having me, guys.
Okay. Thanks. Appreciate it again. Michael Becker, Jakob Andersen. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.